Hi, guys. Welcome to the sixth episode of WTW, the weekly trading wrap up, where we talk about the weekend markets from a trader's perspective, what to focus on and what to ignore. So let's begin. This is the week of December 23rd. It's a shortened Christmas week. Um, there was some action and some interesting developments that happened. Even though there wasn't a lot of volume, there was some volume here. We can see that it picked up. And there were some interesting things that happened. Okay, as you can see, we always start with a chart of the S&P 500, the SPY, and I've marked the arrow. The arrow here, the red arrow, is Monday, Tuesday, Wednesday. Excuse me, Tuesday, Thursday, and Friday. There is no Wednesday. That's Christmas. So it's a shortened week, and as you can see, uh, it followed through in a bullish manner because this is Friday's candle, where if you remember from last week's episode, I was very bullish, and I thought it marked temporary low in the market, given the extreme oversold conditions and extreme negative sentiment. I was expecting a huge bounce back, and we got that this week. Well, not huge, but a decent one. Okay, so let's go with Monday here. Big jump up. The day finished up like 0.6%. So, what happened on Monday? The first thing that came out is new home sales and the CB Consumer Confidence Index. Okay, new home sales we can just ignore because, as you can see from our macro here, what matters to us is building permits because they lead. Okay, they lead to new home sales. So new home sales is like a lagging indicator. Okay, building permits should have already told us what the new houses that are going to be built are going down the line. So we look at building permits, and we covered that last week, and we can just ignore new home sales. Okay, we look at leading indicators, not lagging or concurrent. Although in some cases we make exceptions, but in this case we do not. So forget about new home sales, and we also had the CB Consumer Confidence Index. Okay, so I don't look at the excuse me, I just knocked that down for no reason. I don't look at the CB Consumer Confidence Index. I look at the University of Michigan Consumer Confidence Index. And that one we should add, okay? This one, the University of Michigan Consumer Sentiment Index came out on Friday. I forgot to include it, so I will be including it in today's, came out last week on Friday. We'll be including it in today's session, okay? Because it is important. And as you can see, it's same as the building permits. We look at the trend, which matters, and the absolute level, okay? Under 70 is very low, and over 95 is very high, historically speaking. Now, what do I mean by that? Okay, so let's go to the University of Michigan Consumer Confidence. Trading Economics, consumer confidence number came out last week at 74 points. Okay, as you can see, it's a monthly indicator, and it from August, September, October, November, December, it's in an uptrend. Okay, we went from 67.9 all the way to 74 now. Okay, obviously it isn't as high as it was in the beginning of the year. It reached almost 80, 79. But it's trending higher from the depressed levels of the summertime. Okay. Now, why is this important? Okay, let's go to the maximum figure here. Okay, what we're looking here is the maximum view of the University of Michigan Consumer Sentiment Index since 1955. Okay, from 1955 all the way to now. And as you can see, when it gets below 60, like 60s is pretty low. 70 is low, but 60 is a level where it gets to extreme low conditions. And above 100, it tends to be a peak. So a trough tends to be around 60 before it reverses, and a peak usually about 100 before it goes down again. It doesn't have to, it can get a bit lower, but that historically is a very high number. And under 60, 70 is low, but under 60 is extremely low. And it usually reverses then. So that's the situation that we have now. We have under 60 And when did that happen? It went to 59 in March of 2022, at the depths of the correction that we had, where the market dropped like 20%. You can see the consumer sentiment was going down the entire time, 2021. Okay, but now we see the uptrend here, and that's what's the important thing. We see we're in an uptrend. Sure, it goes up and down, but here's the uptrend. Okay, so it's telling us that the consumer is slowly getting more and more confident. Okay, not super confident, still at low levels, so at 74, which is a historically pretty low level. We have room to grow, but the consumer is doing okay here. Okay, and if we go and look at this exact same chart, but in a different view from the FRED database, the Federal Reserve database of St. Louis, we see the exact same thing here. Everything above 100 is a peak. Everything below 60 seems to be a trough. But we also have here the shaded areas which denote recessions. Okay, we had the 2021 here, 2008. And as you can see, consumer confidence dips before the recession officially happens. Okay, in the year 2000, it dipped before the recession officially happens. And this is going back all the way to the 70s and 80s. It's the same story. Okay, there's always a dip right before. So this is why it's important to include it in our macro analysis. It is a leading indicator. Okay, and as you can see right now, the uptrend here, and we're in the 74. Okay, like within low, but not super low, like within a comfortable level. 70 and 80 is like mid. You want it to get above 80 and above 90 for the consumer to be really confident. Okay, so this tells us that the consumer is starting to get his confidence back. He's not there yet. Okay, and that's why we decided to add it to our macro analysis here as an indicator. Okay, so that's it for the consumer sentiment indicator. Let's go back to SPY. So what else happened on Monday? Well, the only thing that I see that is of significance would be MicroStrategy had an announcement that it bought 5,262 Bitcoin between December 16th and December 22nd. Let's go to Bitcoin. This is Monday Bitcoin. Okay, so on Monday here, Michael Saylor and MicroStrategy announced that they bought 5,262 Bitcoin between the 16th, which is here, 16th and 22nd, but they bought them all here at an average price of 106,662. Okay, and this was I got this information from the MicroStrategy 8K form, which talks about well, you have to file it when you're talking about your securities and stuff like that. So let's blow this up higher. Okay. So MicroStrategy, where does he talk about his Bitcoin? Okay, Bitcoin holdings update right here. Okay. So like he said, he announced it on Monday. He announced that he acquired 5,262 Bitcoin for a little bit more than $500,000 in cash at an average price of 106,662 per Bitcoin. Okay. And he also announced that as of December 22nd, they had 44,262 Bitcoins that they've acquired for an average price of 62,257. Okay, so if we go back, even though the price of Bitcoin is like 94,000 right now, he bought it at this level around 62. Okay, so he's well in the money. If it drops to 62, he'll be breaking even on his purchases. Okay, so he also disclosed his Bitcoin yield, because this is what I think the market got a little bit excited on Monday about Bitcoin, in that he announced that he had a Bitcoin yield of 47.4%, okay, in 2024 so far, as at December 22nd. So 47.4% return on his Bitcoin, that's what the Bitcoin yield is. Well, not really, because to me, a yield is like income earned um, expressed as a percentage. Okay, meaning that, let's say we're talking about dividends. A dividend yield would be, let's say you made you were paid $1 of dividends, and you have a stock that is at $100 a share. The yield would be 1 divided by $100, which would be 1%. So you earned 1% per share in dividends. That's your yield. Okay. Same thing with bonds. You earn 5% yield. You earn $50 per $1,000 bond is a 5% yield. So it's your return over the price based on over a time period, expressed as a percentage. Okay. Whereas here he defines the Bitcoin yield as the percentage change period to period of the ratio between the company's Bitcoin holdings and its, let's say, its fully diluted shares outstanding. So it's the amount of Bitcoin divided by the amount of shares outstanding. Okay, so that's not a yield. That's not like a return on Bitcoin. Because when I heard he made a 47% Bitcoin yield, it's like, I don't know, his Bitcoin returned him 47.4%. I thought he like loaned out his Bitcoin and he got back 47% as like interest on it. But no, that's not what happened. He's using this terminology a little bit badly in my view, because it's basically, he's trying to show here, like if you read further, they believe that this KPI, this key performance indicator, it's to supplement and investors' understanding of the company's decision to fund the purchase of Bitcoin by issuing additional shares of its common stock. Okay, so if you look carefully here, MicroStrategy issued convertible debt. We talked about this last week or the week before in a previous WTW podcast, where his strategy is to issue debt and buy Bitcoin with it. Okay, so he believes that, in this case, convertible debt. So he believes that because this ratio is 47% higher than it was at the beginning of the year, that the Bitcoin that he bought outstripped the dilution of the stock. Okay, so he feels that, yes, I issued more shares, but look, my Bitcoin were appreciated more, or I have more Bitcoin than I have shares, so it's a good strategy because you're getting more bang for your buck. Now, this to me is a little bit suspect because it's not really a yield, and you don't know. I mean, if Bitcoin drops to 62, he's basically breaking even on his Bitcoin, but he still has the same amount of Bitcoin. He still has 44,600, whatever. So the yield, the yield would be the same if Bitcoin dropped to 62? No. So it's a little bit suspect. Like, I don't really like this Bitcoin yield thing, but, you can take it with a grain of salt. He is so far he's doing great, because he's bought at 62 and it's at 90 something, so it's over 50% return on his Bitcoin, just on his Bitcoin. Forget about the shares outstanding, just on the Bitcoin return. And a lot of people are emulating this strategy, okay, a lot. So they're just jumping on the bandwagon. Is it good? Well, that's for posterity to decide. If Bitcoin rips above 100 and 110, 120, and yeah, it probably will be good. If not, if it crashes, it's not going to be so good. Okay, so that's what came out on Monday, this day. So let's go to Tuesday. Tuesday was a follow-through day. Nothing really happened. We had the Richmond Fed Manufacturing Index. It's not meaningful. You can just ignore it. But something interesting did come out of China here. So let's look at China. China, this is Monday. This is but then we're looking at the Tuesday, right? So let's look at Tuesday here, because that's when it came out. So on Tuesday, when that news came out, it popped up the Chinese market. Oh, by the way, I'm looking at the FXI, which is the China Large Cap ETF. This is my proxy for the China market. Okay. So on Tuesday, from Monday to Tuesday, the market did rip because China issued 3 trillion yuan in bonds to stimulate the economy. Okay. So this is exactly what we expected. Going back weeks, we said that our Chinese outlook is that Xi will probably give measured doses of stimulus to trying to figure out what the right dose is because he doesn't want to spark inflation. He wants to figure out the right dose to rip the market because, look, China was much higher. Okay, the index was much higher. It's still near lows. It's off the lows, series of higher lows, but it's nowhere near the highs of the U.S. market and other markets. So he wants to stimulate his economy, but he doesn't want to do too much to spark more inflation because, he wants to be a good steward of the economy, I assume. So, but at one point, we know what's going to happen. Like, at least my outlook is that, they're going to bring out the bazooka eventually because now these are just like a pot shots. These are BB guns because, 3 trillion won is just $400 billion. For the Chinese economy, it's not a lot. It's like 2.4% of GDP. I think he needs to do at least 10% of GDP, 50 before you see a huge move. Okay, so you need to do like maybe 10 times this amount, 20 trillion won. Let's see. Okay, so it will happen. It's just not today. And you see, it did stimulate, but not a lot. It wasn't like this. After a big announcement, people were expecting a lot, nothing. Same thing, expecting a lot, nothing. Expecting a lot, nothing. Okay, so China, we still have the same outlook. We're expecting that big bazooka. This ain't it. Let's go back to SPY. Okay. What did happen on Tuesday is that, and the big story for the week, and the big story like going on right now, the narrative is the U.S. 10-year and inflation. That's what we should be looking at. Okay. So this here is Monday. This is Tuesday. Okay. So as you can see this week, yields went up. They went up about 10, 11 basis points. Okay. So this is something we should be looking at because the market is very skittish when it comes to inflation. Okay. And we're looking at the U.S. 10-year, which is the U.S. government bond 10-year yield, which is the benchmark interest rate for the economy. And we talked about why previously. As you can see here, we had a series. It went as high as 5%, and then a series of lower highs, which means it was in a downtrend. But recently, this was broken because people were scared of inflation. Okay, this is all inflation expectations going higher and all fear due to that inflation. As we can see, these is the 10-year break-even inflation rate. As you can see, it went higher. It's all based on the inflation. Okay, back to the U.S. 10-year. So, technically speaking, it broke this level. So it broke the downward trend. However, if you look more, it's getting to be overbought. And I'm still not convinced like inflation is going to come in, okay? Even though like we can see that the Fed, what is it, the Fed Watch tool. We should always go back to the Fed Watch tool to see what the expectations are for rate hikes because they are linked to the U.S. 10-year and the expectation for inflation expectations. They're both linked. Okay, so whenever we think inflation is going high, we look at the Fed Watch tool because if inflation is going high, the Fed is not going to cut rates. Okay, and as you can see, for January, this coming meeting, the 29th, there's an 89% chance that there's no change, that it stays at 4.25% because that's the rate right now. That is the federal funds rate. The overnight lending rate is at 4.25%, down 1% from the highs of 5.25. Okay, so and for the entire year, like what happens? That's in January meeting. Let's see what happens for the March meeting. Well, okay, there's like a 46% chance he cuts by a quarter point. What about May? May, there's probably going to be for sure a cut of 25 points, and then maybe by May it's 50 points. So here you have your two cuts here. And by December, that's mostly two cuts. Very rare. 80% like 64% chance of two cuts, let's say. So it's still two cuts. Outside chance of three, very outside chance of none. So let's say two. So 2 cuts is nothing. Like the market thinks there's only going to be 2 cuts because of this inflation expectations ripping. Okay, that's why the U.S. 10-year is ripping. So we have to acknowledge the fact that there's been a technical breakout, if you will, of these yields. So there is a red flag on the play, and we should be paying attention to it. However, there are other things that are still bullish because despite this breakout, the SPY is still almost near its highs. Okay, this is the Friday close. So we're at near highs. The market doesn't even care about the inflation, or it doesn't think that it's going to be that bad. Okay, or the economy is going to be much better. So it'll mitigate inflation because when the economy is good, you produce more goods, and if you don't print money, that is deflationary. Okay, so the market doesn't seem to care that much, although there is a warning sign on the U.S. 10-year, like we mentioned. Okay, so we should keep that into effect. However, the reason I don't think inflation is going to pick up because the other classical proxies for inflation are not screaming like the U.S. 10-year yield. For example, oil. The oil market, this is oil, it's at $70 a barrel. It's flat for this whole time. While the U.S. 10-year was ripping, it's flat. Usually oil would be ripping too if there's inflation. And of course, Dr. Copper futures are basically flat too. They're not moving higher. They're at $4.12 a pound. It's doing nothing. So the other proxies for like commodities that usually go up with inflation are basically flat. The only thing that is up is the U.S. 10-year yield. Okay, so that to me says that, and technically we're getting higher. Maybe it hits this high and then turns back down again. I just don't see inflation really picking up that much without other things helping it go up as well. And we saw that the economy is just growing at 2.5-3%, which is what it grew in the first President Trump term. And President Trump didn't have inflation over 2% his whole tenure. So I just don't know. And we don't have money printing. We don't have massive reduction in interest rates. I mean, what is going to make inflation spark that much for the 10-year to go above the previous highs? I mean, it was here when rates were at 5.25%. When the federal funds rate was at 5.25%. And now it's now a full 100 basis points, a full percent lower, and the yield's at 4.62. I don't know. It's very suspicious to me. I just don't see how it can continue to really go higher, fundamentally speaking. Right. So that's why I think it might be muted, and I think the Fed is thinking of just cutting twice next year. So I just don't know. Like it just makes no sense to me that inflation is ripping and nothing else that supports that thesis besides the U.S. 10-year. That's not ripping either. You don't have oil ripping. You don't have jobs. You see the continuing claims and the initial claims are still holding up. It's not like we're having full-blown like economic expansion with money printing or something, because this would signify that the economy is going to do so good, so well, that it'll spark inflation and that the Fed can't cut or will only cut twice. This is what this is saying. Okay? Any change to that and it'll really tank. Okay? And this is why, going back to the SPY, we are climbing a wall of worry. Okay? People are still not super convinced. We saw the consumer sentiment index still at 74. That's not amazingly high. They're not super confident. Okay? And yet we still have a series of higher lows and higher highs. And this didn't violate this higher low. This never went below that. It didn't violate it. It opened lower, but then it closed higher on Friday. Okay? This still held. And even if it didn't, we still had these three that held. Okay, we're getting in trouble when it goes back down here. But the fact that a series of higher lows held in the market means that, and we're only like what, not even maybe 1.5, 2% off the highs, with inflation expectations putting the U.S. 10-year at 4.6 something percent, near the 5% high, when the Fed's rate was at 5.25, nearly 1% higher, it just makes no sense to me that inflation expectations will be that high, or that the 10 years should be that high. Okay, but it's a yellow flag. Okay, it doesn't negate our bullish thesis. Oh, and one more thing. If we look at the fear and greed index, we're at 34. We're still at fear. So not only is this fear is expressed by the inflation expectations in the U.S. 10-year at 4.6%, but the market near highs and we're still at fear. This is a wall of worry again. Wall of worry. So if we're at fear, I'd get worried in the market when we get to this extreme greed level, like greed and extreme greed, okay? Because then that could really propel the market to like 620-ish, 620, let's say between 620 to 630, okay? Because we went from like 580 to 600, 595 now, and barely, it didn't move the needle. We were like 25, 28, and it went to 34. We're still at deep fear, right in the middle of fear, and the market went up, 15 points. That means we could easily go another 15, 20, 30 points and only get to this level. So I still see the market in the new year going up to the 620-ish level, 630 maybe. And then we'll start worrying about whether there's going to be a correction. But right now, the fear here is all driven by the U.S. 10-year and inflation expectations. That's it. This is still telling me that people have one foot out the door. Okay? So that was Wednesday. Thursday, what happened? Thursday was initial claims. Okay? Initial claims. Do we have initial claims? Yes. Initial claims were at 219,000. They're expecting 220,000. Same as before. Okay? They're not exploding. We're not having any kind of recession. It's not ripping higher where people are filing for, they've been laid off and they're filing for unemployment. Nope. Okay? Continuing claims went up to 1910K versus 1864. So that is rising, and that's not good. Okay? But initial claims are still here, still at these levels. Okay? So, let's see the continuing claims here. Okay, that ripped higher to like 1.9 million. So it's getting higher. So the continuing claims are getting higher. Oh, let's just see this level here. Oh, they're still okay. They're not as high as in 2020. Continuing claims. So slight flag here, but I wouldn't worry about it. The initial claims are holding lower and at the level we expected. So maybe a little bit wording on continuing claims, but let's say mixed, but nothing to be worried about. Initial claims is what I really look at. 219,000. Not really something to worry about. On Thursday, and that was the only thing that really came out. And Friday, nothing came out, but the market was tanking. Okay, the market dropped. It was down 1.5% at one point, and then recovered half of that and to close at, what was the close? 595. Okay, so we're up literally 15 points since that Friday scare, which didn't violate this low. So technically, even if it did, this is when we get into trouble. So, anyways, we have we have fear because of this inflation expectation, which gives us more fuel to go up even higher to 620, 630 when we'll start getting into the greed level. Okay, I don't know when that will happen. I suspect very soon, like in a month. Within the next 2, 3, 4 weeks, we should see it at 620, 630. That's my view. Given the fact that we're still scared, we're still climbing a wall of worry, and it's all due to this, the U.S. 10-year. right at the highs, right at the highs of, and violating this level. Okay, but I give you my fundamental reason as to why I don't think it's going to go back higher than this. Okay, so that's what came out on Thursday. Nothing really big, and on Friday was like nothing came out. So I think this is the fear of either it's the fear of the U.S. 10-year, but the U.S. 10-year, did it really go up? Yeah, on Friday it did go up. So you can say that it was maybe because of the U.S. 10-year. This is Friday, U.S. 10-year went up. So yeah, I guess you can say that it was due to the U.S. 10-year, but this is an extreme move for just that small. Maybe somebody had to liquidate in the morning, and then the market came back. Who knows? You never know what the real reason is for this market's big downturn in the morning before coming back. But it really doesn't matter. Okay, that's just a short-term action. Okay, we have to look at the days and weeks ahead, because I suspect that given the fear and given the fact that I don't think inflation expectations are going to be that high going forward, and the GDP online, and which is around 3%, and the initial claims holding up, and the consumer starting to get more confidence, all of that is still bullish for the markets, with maybe a slight yellow flag because the yields are breaking out technically, let's say, although that might just be a little blow-off move before they come back down. So that's it for this shortened week. My views are still the same. I'm still bullish, although we have a little bit of a caution flag coming out. It's not enough to get us to panic, especially since people are already panicking. We have a wall of worry, and technically speaking, nothing has been violated. So we have the fundamentals and the technicals on our side. So having said that, stay bullish.